Let me give you three numbers before I say anything else. $75.95, $4,705, and 575 million ounces. Silver is at $75.95 today, down 2.28% from yesterday's $77.89. Gold is holding near $47.05, and 575 million ounces. That is the total paper silver open interest still outstanding on May COMEX contracts as of this morning. Write that number down, hold it in your head, because everything I'm about to tell you over the next 10 minutes orbits that single figure. 6 business days from today is May 1st, the May 1st notice day for COMEX silver futures, 6 days. And the gap between paper reality and physical reality in this market has never been wider in recent memory. I am going to walk you through exactly what that means, not in vague terms, in specific, measurable, data-backed terms. Let's go. I want to start with what is happening physically in the world right now, because it is the backdrop against which every single silver trade is being executed today. The Strait of Hormuz has been effectively blockaded since February 28, 2026, when the United States and Israel launched military operations against Iran. Iranian forces formally declared the strait closed on March 4th, and have carried out at least 21 confirmed attacks on merchant vessels since then. As of this week, Iran seized 2 vessels and fired on a third. Ship traffic through the strait remains sharply below pre-war levels. Under normal conditions, that waterway handles roughly 20% of the world's seaborne crude oil and a significant share of global LNG. The disruption has been characterized as the largest oil supply disruption in the history of the global oil market. That is not a fringe opinion. That is the assessment of leading international energy bodies and analysts covering this crisis in real time. Now, what does a closed strait have to do with silver? 2 things. First, elevated oil keeps inflation elevated. Inflation keeps the Federal Reserve frozen. The Fed is currently sitting at a 3.50 to 3.75% funds rate, with essentially zero probability of a cut at the April 29th meeting. No rate cuts means dollar strength. Dollar strength means headwinds for the paper silver price. That is the exact mechanism that has been dragging spot silver down from the $121 peak in January 2026 to the mid-70s range we are trading in today. Second, and this is the part that almost nobody in the mainstream financial press is connecting, the energy crisis is the single most powerful accelerant for industrial silver demand that could exist. Every government watching their energy supply get choked through a 34-kilometer strait is now aggressively rethinking its dependence on Middle Eastern hydrocarbons. Europe entered this crisis with gas storage at just 30% of capacity. Dutch gas benchmarks nearly doubled by mid-March. The European Central Bank had to postpone planned rate reductions and raised its 2026 inflation forecast. What do you do when oil and gas from the Gulf become unreliable? You build domestic renewable energy, fast, and the primary industrial input for solar panel manufacturing is silver. The Silver Institute projects record solar demand in 2026. The energy crisis does not destroy silver demand. It permanently raises the structural floor beneath it. Now let me give you the numbers that actually matter, not estimates, reported figures. COMEX registered silver, the only silver that can legally be delivered against a futures contract, currently stands at approximately 76.88 million ounces. That is the most recent publicly available CME warehouse figure. Against that registered pool, there are approximately 100 open contracts on May 2026 COMEX silver futures, representing approximately 575.5 million ounces of paper silver. Do the math, 76.88 million ounces of real deliverable silver. 575.5 million ounces of paper claims against it. The coverage ratio, how much physical metal actually backs the open paper, is 13.4%. COMEX analysts define stress territory as anything below 15%. This is the 6th consecutive reporting period where the coverage ratio has stayed below that threshold. It has not improved once. The paper leverage ratio is 7.5 to 1. For every single ounce of silver that can actually be delivered out of the registered vault, 7.5 paper ounces are claiming it. Now, before anyone says that is just how commodity markets work, yes, COMEX is designed with the assumption that 97 to 99% of contracts will roll forward or settle in cash. In a quiet, normal month, that holds. Delivery demand represents 1 to 3% of open interest, and the registered vault handles it easily. but the last several months have not been quiet or normal. In January 2026, delivery rates spiked toward 5 to 10% of contracts. Institutional buyers stood for actual physical metal instead of rolling forward. In March 2026, the market delivered over 40 million ounces in a single month. Now run the May numbers with the correct open interest of 575.5 million ounces. At just 5% delivery rate, which is below what we saw in January, demand would be 28.7 million ounces. At 10%, it is 57.5 million ounces. That is 75% of the entire registered vault wiped out in a single delivery cycle. At the March delivery rate of roughly 18%, demand would exceed 103 million ounces, more than the entire registered vault, more than once over, and the vault has not meaningfully replenished since March. The registered pool that must supply May deliveries is roughly the same size as the pool that already strained to supply March deliveries. This is not a theoretical stress test. This is the operational reality of COMEX silver infrastructure going into the most watched delivery window in years. Now I want to explain the mechanism that will almost certainly be used before May 1st to try to relieve the delivery pressure, because understanding it tells you exactly what to watch for in the price. The mechanism is called the Exchange for Physical, or EFP. It works like this. A holder of a COMEX May futures contract is approached, typically by a bullion bank, and offered a cash premium above the current spot price. In exchange, that contract holder gives up their right to physical delivery from COMEX registered inventory and instead accepts settlement through the London OTC market. In a normal market, EFPs are routine and the spread is just a few cents. Nobody notices. But here is the problem with using EFPs as the primary safety valve for May 2026. London's available free float, the silver that is not already committed to exchange-traded products, is severely constrained. Approximately 83% of silver in London vaults is currently tied up in ETPs. When the EFP mechanism tried to move metal from London to New York earlier this cycle, silver lease rates spiked to nearly 40% annualized. That means it cost 40% per year just to borrow silver for short-term delivery. That event in late 2025 was the preview for what May 2026 is building toward. If delivery demand in May exceeds historical norms, the EFP premium will rise. That rising premium is, in effect, a forced price increase. If the exchange needs to offer contract holders $5, $8, or $10 per ounce above spot to convince them not to stand for delivery, then silver just repriced. Not through a dramatic exchange default, not through rule changes, through the price mechanism itself, clearing the obligation at the market's actual scarcity price. That is how delivery squeezes resolve in the commodity world, not with collapse, with rapid, significant price discovery. Let me give you the big picture, because the May delivery mechanics are not happening in isolation. They are happening against a structural backdrop that makes every squeeze more consequential than the last. The Silver Institute projects the 2026 silver market deficit at 46.3 million ounces, up from 40.3 million ounces in 2025. This is the sixth consecutive annual deficit. Since 2021, the cumulative above-ground silver drawdown has crossed 760 million ounces. That is not a market building reserves. That is a market burning through reserves every year just to keep functioning. The supply side cannot fix this quickly. Over 70% of silver is produced as a byproduct of mining for copper, zinc, and lead. Miners cannot simply decide to produce more silver. New mine development from exploration to production takes a decade or more. That pipeline does not exist at the scale the market requires. On the demand side, JP Morgan forecasts silver will average $81 per ounce for full year 2026. The Reuters analyst survey puts the 2026 average at $79, $50. Bank of America has flagged a bull scenario extending meaningfully higher if physical shortages intensify. And here is the key insight that most macro traders are missing. The industrial categories consuming silver are not price sensitive. Data centers building AI infrastructure do not cancel server orders because silver connectors cost more. Solar panel manufacturers continue deploying capacity. EV production continues growing. The demand floor is structural, not cyclical. High prices slow jewelry demand. They do not slow the energy transition. Here is the data point that ties everything together, and most people have completely missed it. Since the start of 2026, a significant volume of silver has completely left the COMEX vault system entirely, not transferred between categories, not reclassified from registered to eligible. Gone. Physically removed from exchange-approved storage. In just 1 week in January, over 33 million ounces left the system in a single week, one of the largest weekly outflows ever recorded. This is the signature of a very specific type of buyer, an institutional actor who opens a futures contract, takes delivery, and then immediately withdraws the metal from the vault, removing it permanently from the deliverable pool. Someone is methodically draining the COMEX registered inventory, and that metal is not coming back to supply May deliveries. It no longer exists inside the system. Here is your one action item for the next 6 trading days. Every afternoon after market close, CME Group publishes updated May silver open interest figures at cmegroup.com. Today that number is approximately 115,100 contracts, representing 575.5 million ounces. Watch what it does each day between now and April 30th. If the number drops rapidly, say 15,000 to 20,000 contracts per day, traders are rolling forward to July at speed. Delivery pressure is being managed. The system is functioning normally. If the number stays elevated, if it is still above 50,000 contracts heading into the final 2 days before first notice day, delivery demand is building. The physical infrastructure of the exchange will be tested in real time. Remember the math. At 575.5 million ounces of open interest, even a 5% delivery rate produces 28.7 million ounces of demand. The registered vault holds 76.88 million ounces. At 10%, it is 57.5 million ounces, 75% of the vault. At March rates, the number exceeds the entire registered pool. Watch the open interest number. It is your only real-time signal of which scenario is playing out. Here is the cleanest summary of everything. There are 2 silver markets operating simultaneously right now. The paper market is trading Iranian diplomatic headlines, Fed rate expectations, and dollar movements. It sold silver from $121 down to the mid-70s over 3 months because Hormuz kept inflation elevated and rate cuts off the table. Yesterday it dropped 2.28%. Today it is trying to stabilize. It will react to whatever the next headline says. It does not read the COMEX depository report. The physical market reads the depository report. It sees 76.88 million ounces of registered silver. It sees 575.5 million ounces of paper claims. It sees 6 days to first notice day. It sees a vault that has not recovered despite 6 weeks passing since March's massive delivery cycle. It sees a 6th consecutive annual deficit widening to 46.3 million ounces. It sees record institutional outflows pulling metal permanently out of the exchange system, and it keeps showing up, quietly, methodically, taking delivery, withdrawing metal, removing it permanently from the system. These 2 markets cannot stay disconnected forever. They never do. The physical market always, eventually, sets the real price. May 1st is 6 days away. The convergence has a deadline. Silver at $75.95, gold at $4,705. Registered COMEX vault, 76.88 million ounces. May open interest, 575.5 million ounces. Coverage ratio, 13.4%. Paper leverage, 7.5 to 1. 6th annual structural deficit confirmed. Record institutional vault outflows confirmed. The paper market is confused. The physical market is not. Watch the open interest number every single day from now until April 30th. One word in the comments: bullish or confused. I will see you tomorrow.